Hi everyone, I'm Debbie Roberts, owner and financial advisor at Property Apprentice. Join us today for the Week in Review, where I talk about current events for the everyday investor and home buyer. Our topics for this week: topic number one from RNZ on the 8th of May. First home buyers benefit from lower prices and less competition from CoreLogic. Second topic from Good Returns on the 8th of May. Mortgage borrowers hedge their bets on OCR coming down soon. Topic number three from the New Zealand Herald on the 7th of May. KiwiSaver investments ride a wave of optimism. Fourth topic from One News on the 9th of May. Budget 2024. Willis promises meaningful but modest tax relief. Topic number five from Oneroof on the 8th of May. Tony Alexander. When homeowners should expect the magic 1% cut in mortgage rates. So first up this week from RNZ on the 8th of May. First home buyers benefit from lower prices and less competition, CoreLogic. First home buyers are capitalising on reduced property prices and decreased competition, as indicated by the latest data. In the first quarter of 2024, first home buyers made up 26% of all purchases, exceeding the long-term average of 21%, according to CoreLogic's biannual first home buyer report. Calvin Davidson, CoreLogic's chief property economist, noted that these buyers were leveraging low deposit lending options from banks, along with first home buyer grants and loans. Some buyers are compromising on property location and type to make their purchases. However, fewer transactions were finalised in the first quarter, reflecting the overall downturn in the housing market. Davidson observed a slight surge in price growth at the end of 2023, followed by an increase in property listings in early 2024, contributing to a deceleration in property values and shifting conditions in favour of buyers. During Q1 2024, the median house price dropped to $695,000 from $699,000 the previous year and $715,500 in 2022. Davidson highlighted that first home buyers are paying significantly more than the lower quartile bottom 25% of all buyers, where the median price stands at $565,000. This data suggests that many first home buyers are not entering the market at the lowest price point and moving up gradually, but are starting well above the bottom tier of the housing ladder. Despite rising mortgage rates and an increase in rental costs, Davidson emphasised that the extra cost of mortgage payments compared to rent remains considerable, indicating that most first home buyers are motivated by factors like stability rather than purely financial considerations. Davidson expects robust first home buyer activity to continue throughout 2024 and possibly into 2025, especially considering ongoing challenges faced by other buyer groups, such as investors. So my thoughts on this are that home buyers very rarely are swayed by things like what's happening with capital growth and even with bank interest rates. A lot of first home buyers haven't actually paid too much attention to what's going on with interest rates before they first approach a mortgage advisor or a lender. So it's great to see that we've got first home buyer activity increasing. Means more and more people are going to be owning their first home. And that is certainly going to help them further down the track, especially when they get closer towards retirement age. Second topic for this week in review from Good Returns on the 8th of May. Mortgage borrowers hedge their bets on the OCR coming down soon. The 1-year fixed interest rate remains the favoured choice among mortgage borrowers, with economists speculating that November could see a potential OCR reduction by the Reserve Bank of New Zealand. Some economists are predicting that the OCR could reduce in August. Others are predicting that it's not going to reduce until early next year. The Reserve Bank has indicated it may not begin lowering the official cash rate until middle of next year, but some bank economists and financial markets disagree. Recently, both ASB and ANZ have reduced their mortgage rates. ANZ, the largest bank in the country, reduced its 6-month and 1-year fixed home loan rates by 10 basis points. RBNZ data from March reveals that the 1-year fixed term accounted for 42.1% of all new owner-occupier lending. Additionally, the popularity of 18-month terms has increased among borrowers, rising from 9.8% to 13%. Borrowers are anticipating interest rate declines later this year, avoiding longer term commitments. Consequently, 2 and 3-year fixed terms have dropped to historical lows of 10.2 and 3.3% respectively. 4-year fixed terms have remained steady at a historical low of 0.3%. Although residential investor lending remains subdued at the moment compared to its peak in 2021, total lending rose to a $1.3 billion mark last month, with 45.7% of it on 1-year fixed terms, up from 41.4% in February. The share of total new residential lending on fixed interest rates increased to 81.7% last month, which is an increase from 79.9% in February, probably due to the significant gap between the floating interest rate and fixed interest rates that are currently being offered by lenders. Compared to March last year, total monthly new residential lending was up 0.5%. The share of owner-occupier loans on floating terms decreased to 17.5% last month, following an 8-month high of 19.5% floating in February. Similarly, the share of loans on 6-month fixed terms dropped to 12.6% after reaching a historical high of 15.1% in February. New residential investor lending on 6-month fixed terms also decreased from 19.9% in February to 16.9% last month. My advice is that if you're coming up for a fixed rate review on any of your mortgages, get advice from your mortgage advisor and they can have a look at your overall position and give you some direction there, help you make your decision as to which fixed term is appropriate for you or whether it is appropriate for you to be on a floating interest rate. If you'd like to learn more about investing in property, join me at one of our free events called How to Succeed with Property Investing. I'll discuss strategies for successful investing from my perspective as a financial advisor, and these are available live, online, or in person. Check out propertyapprentice.co.nz for upcoming dates and register today. We don't sell property, so it's all about increasing your knowledge to reduce your risk. If you've already been to one of our free events and would like to find out more about how we can help you to reach your financial goals with property, you can also book a no-obligation phone call or meeting with my husband, Paul Roberts, via the website. Third topic for this week in review from the NZHerald on the 7th of May, KiwiSaver investments ride a wave of optimism. Global market optimism boosted the value of KiwiSaver assets in the first quarter of the year, according to Morningstar's latest survey. During the 3 months ending in March, KiwiSaver savings increased by approximately $4 billion, reaching $108.6 billion in total. Returns for the quarter varied from 2% for conservative funds to 8.8% for aggressive funds. Morningstar noted that key trends affecting New Zealand investors included inflation and global interest rates. Central banks, including the Reserve Bank of New Zealand, maintained steady interest rates, indicating progress in addressing inflation concerns. The quarter saw strong performance in international shares driven by robust US corporate earnings and enthusiasm for technology stocks. While New Zealand's economic growth was expected to be modest, the US economy continued to show strength. Morningstar expressed cautious optimism for the first quarter, highlighting improved global growth prospects and strong equity market returns, particularly for unhedged holdings, benefiting from a weaker New Zealand dollar. Over the past decade, aggressive KiwiSaver funds provided the highest annual return at 9.1%, followed by growth at 8.4%, balanced at 6.8%, moderate at 4.8%, and conservative at 4.3%. And just looking at those figures, I'm assuming that those are gross returns, so before fees and taxes. In terms of market share, ANZ led with $20.4 billion in assets, followed by Fisher Funds at $16.7 billion, ASB at $16.6 billion, BT Westpac $10.7 billion, and Milford Asset Management $8.6 billion. So again, if you're looking for help with KiwiSaver, make sure that you talk to a KiwiSaver advisor rather than just going directly to a bank or a fund provider, because a KiwiSaver advisor could give you access and compare different funds from different providers to make sure that you're in the right fund for your situation and one that's performing really well. Fourth topic from One News on the 9th of May, Budget 2024. Willis promises meaningful but modest tax relief. Finance Minister Nicola Willis has announced that this year's budget will include substantial tax relief for working New Zealanders, focusing on middle and lower income earners. In a speech to the Hutt Valley Chamber of Commerce, Willis emphasised the government's commitment to supporting New Zealanders through economic challenges. The tax relief package aims to increase take-home pay for 83% of individuals over 15 years old and 94% of households, which will be a welcome relief, I'm sure. Willis assured that these tax cuts will be responsibly funded through careful savings and targeted revenue measures. The budget will prioritise the squeezed middle and will involve increases to income tax thresholds to address fiscal drag and encourage greater financial returns from work. Willis highlighted that tax relief will benefit the economy. Additionally, Willis acknowledged the public sector job cuts and expressed gratitude to public servants for their efforts in achieving savings. Despite a focus on fiscal responsibility, the budget will allocate significant funding to essential services like health, education, disability services, and police, with an operating allowance of less than $3.5 billion. The government aims for a balanced approach, offering tax relief while ensuring essential services receive the necessary funding within a constrained operating allowance. They are, after all, trying to fix a bit of a fiscal mess and keep us out of going into a really serious recession. Topic number 5 from Oneroof on the 8th of May, Tony Alexander, when homeowners should expect the magic 1% cut in mortgage rates. Independent economist Tony Alexander has provided a concerning analysis of the economic outlook, suggesting a challenging winter ahead for both individuals and the overall economy. According to his latest monthly spending plan survey, there has been a notable decline in consumer optimism, with a net 36% more respondents planning to reduce their spending rather than increase it. Specifically, intentions to cut spending are evident across various categories. A net 16% plan to spend less on motor vehicles, a net 44% on eating out, and a net 27% on household appliances and furniture. So it is going to be interesting to see whether that actually plays out, because over the past few months or even a couple of years since COVID, even though people said they were planning on spending less, they pretty much ignored that and went out and spent anyway, which is not helpful when we're trying to fight inflation. The only areas that showed increased planned spending are groceries, obviously, because of inflation and things like that, and international travel, which is reflecting post-pandemic behaviours like revenge travel, for example, when we all got locked up without the ability to travel. So some of us are making up for a bit of lost time there. Job insecurity is a significant concern, highlighted by a record 50% of real estate agents reporting buyer worries about their income, which is an increase from 14% in January. This shift underscores changing employment confidence and its potential impact on work from home preferences and office return policies. The heightened concern about job loss has led to reduced attendance at open home recently, with a net 37% of agents reporting fewer attendees. This shift marks a stark contrast from January, when more attendees were observed. In the real estate market, fear of missing out, or FOMO, has diminished significantly, with only 3% of agents noting buyer concerns about missing out on properties compared to 23% in January and 40% in September. Conversely, worries about a lack of listings have decreased to a record low of 4%. The residential real estate market in New Zealand, which saw an upturn last year, has plateaued and is now slightly reversing. Improvement is not expected until interest rates decrease sufficiently, possibly by the end of the March quarter next year, if not earlier. Overall, according to Tony, the economic landscape is anticipated to remain weak across various sectors until these improvements occur. The prevailing sentiment in the business sector is to survive to 25, acknowledging the challenges ahead. So my thoughts on this are that yes, I think there is a lot more pain in the economy than the Reserve Bank has expected, and I think we just now need that data to back that up, so that gives them the confidence to reduce the OCR, which will help stimulate the economy without keeping inflation too high. So it's a real juggling act at the moment. Having said that, we are certainly noticing that a lot more transactions are going on in the property market. So, for example, banks, they're taking longer to do pre approvals and settlement processes just because of the higher volumes that have been coming through recently. So, real estate agents are starting to notice a bit of a change in some areas in the country. So, although it's not blanket right across the board in New Zealand, there are certainly some areas where buyer interest is starting to increase. It is, however, absolutely still a buyer's market, which is great if you're a buyer. It allows you to take advantage of lower property values and favourable market conditions. If you'd like to learn more, join our How to Succeed with Property Investing event. During these free 2-hour workshops, we cover recent property market data. And as an experienced property investor and also a financial advisor, I'll share valuable insights and expert tips to help you on your journey. Our free events cater to all levels of property investors and first home buyers. And I'll tell you all about how we can help our clients to achieve their financial goals as well. So if you're interested in finding out more about what we do, visit propertyapprentice.co.nz today to secure your spot and register for our events. Alternatively, book a no obligation phone call or meeting with my husband Paul Roberts through our website, propertyapprentice.co.nz. Thanks for listening, and to all you mothers out there, happy Mother's Day for this Sunday. Hope you get spoiled. Thanks for listening.